Hello, I'm Grace. Amid growing concerns that U.S. inflation is reigniting, global attention is focused on whether May's Consumer Price Index, CPI, will exceed the 4% range. Because this data is expected to serve as the most critical indicator for determining the Federal Reserve's future interest rate policy, market nerves are on edge. Reports indicate that while the market's average forecast remains in the early 4% range, fears of it breaking through are pervasive. The resurgence of price increases, which seem to be stabilizing in recent months, is being viewed as a warning signal by economic experts. Particularly, the persistent, albeit modest, rise in service costs and housing expenses has heightened anxieties that this may be a structural issue rather than a temporary phenomenon. Wall Street has already begun adjusting its expectations for rate cuts, originally anticipated for early next year, signaling a disconnect between market optimism and reality. Tension is mounting in the bond market, where traders are betting on additional rate hikes within the year, suggesting that increased interest rate volatility is inevitable. In this climate, global investor sentiment is heavily shaken, with the risk of capital outflows to emerging markets remaining a persistent concern. Specifically, instability in food and energy prices is analyzed as the primary variable driving a potential resurgence in inflation. Recent oil price increases have raised concerns that they could dampen consumer spending sentiment, creating a vicious cycle that leads to increased household burdens. Since food and energy are goods closely tied to daily life, their price hikes directly contribute to the rising cost of living for ordinary citizens. If living costs worsen significantly, this should not be overlooked as a potential political risk rather than merely an economic issue. While the Federal Reserve prioritizes price stability, it requires a delicate balance to simultaneously manage concerns about an economic slowdown. Therefore, the upcoming CPI release will not only directly influence the Fed's future rate decisions, but also serve as a signal for a potential shift in policy tone. If inflation exceeds 4%, the timing for Fed rate cuts is likely to be significantly delayed, implying a prolonged period of tight monetary policy. This could trigger a contraction in liquidity within global financial markets, acting as a sensitive variable with negative implications for global asset prices. Particularly, domestic markets like the KOSBI are bound to react sensitively to external financial volatility, necessitating defensive measures against external shocks. The potential for increased market volatility due to other major issues, such as news regarding a SpaceX listing, must also be considered. As multiple uncertain variables compound, making market predictions increasingly difficult, investors must prioritize cautious responses and robust risk management. Since every data point released tomorrow night will determine the future direction of the market, in-depth analysis based on these results is essential. This inflation metric is expected to serve not just as a number, but as a crucial key to understanding the broader trajectory of the global economy. I'm Grace, thanks for watching.